Alright, so today we're going to be covering candlesticks. This is lesson 3, and we're going to be going over the psychology behind them and pretty much how to read them and what they mean. So in the last lesson you would have seen why we have market structure, why we have these legs in the market, and sort of what's happening behind the scenes, why they're forming. So let's have a look at why these candlesticks are forming and sort of how we can use them to our advantage in the market. So why do we look at candlesticks? Candlesticks can be used as a confirmation for a trade idea. They can also be used to get you out of sticky situations. It can often show you where the trend is going to reverse or carry on. So these candlesticks will be forming at levels of interest, AOI, area of interest. And that's when they give you the best confirmations, when they're at these areas of interest like support or resistance. And I'm pretty sure I talk about that later on, but remember that when it comes to candlestick formations, they happen at areas of interest. So there's also a psychological element to these candlesticks, and they can show you what's happening sort of behind the scenes, you might say. It's important to understand candlesticks in your trading journey. Learning how to read candlesticks is like learning a new language. Imagine you have a book that is written in a foreign language. You look at the pages, but you get nothing from what is written. The same goes when it comes to the financial markets. If you don't know how to read candlesticks, you'll never be able to trade the market. You don't know what you're looking at. When you're brand new to the market, you're just looking at these random sticks and movement going up and down. You don't really know why it's moving up and down or how it's doing it, what's happening behind the scenes. There's psychological parts to candlesticks that you can see and can help you read and understand what's happening behind the market. For example, a big order being placed, which can become a level where it's probably going to retest in the future. We'll get into that more later. So candlesticks are the language of the financial markets. If you obtain the skill of reading charts, you'll understand what the market is telling you, and you'll be able to make a decision based on your knowledge and experience. As I keep saying over and over, the more you keep looking at these charts day in, day out, the more you'll see the same thing happening over and over again. So what makes up a candlestick? Candlesticks are a type of drawing that is used in trading to visualize the price movements over a specific time period. So we'll get more into this later, but depending on the time period you're looking at it, the different candles will show up. Obviously, the lower the time frame, the less strong these signals are, and the higher time frames you'll see stronger candles, and they pretty much have more meaning behind what they are. Whereas if you're looking on a 1 minute chart, it's just chop. It just doesn't mean anything. So each candlestick represents the open, high, low, and close prices within that period, depending on what chart you're looking at. The three parts of a candlestick are the body, which is the main part, which shows actually where price closed and opened. You have wicks, so I'll just draw it out. The main body, this is where price actually closed or opened, depending if it's bullish or bearish. And we have wicks, which show us where price actually went to in that whole time period. And then the color just showing you if it's bearish or bullish. Simple. I'll show you on the next slide. So as you can see, we have a bullish candle, so green, whatever color you have, meaning price is going up. Since it's going up, the open is going to be at the bottom. So right here is where the price opened. In this whole time period, let's just say these are M5 candlesticks. In this 5 minute time period, price would have moved down, moved up to these wicks, but it actually ended up closing right here. Now, for a bearish candlestick, so meaning price movements down, you can see price went just like the other one, from the top of the wick to the bottom of the wick. That's what it did in that 5 minute time period. It opened up here and then closed down here. So the open is higher than the close, so it's given us a red candle. This one, the close was higher than the open, so it's given us a green candle. Very simple stuff. Yeah, just like I said. So if the close is above the open, we can say the candlestick is bullish. And if the close is below the open, we can say that it is bearish. So candlesticks are a representation of a price's range based on a particular time. So when I say a range, I'm talking about the wicks. As you can see, it went all the way up here and all the way down here, but it actually closed here. On the left here we have the 4-hour candle, and it's showing us that it's a bearish candle, meaning price movement's coming down, and it's sort of rejected somewhat of a high, but it's kind of an indecision candle, this one. So it tried to go up, but it didn't, and then it tried to go down, but it kind of didn't as well. This is more of a bearish candle than a bullish candle for sure. But just have a look at the 4-hour candle and the 1-hour candle. So 4 1-hour candles make up one 4-hour candle. And you can see this candle is these right here, just on a different time frame. So when it comes to candlesticks, size does matter. And what do I mean by this? So obviously we know candlesticks have different body sizes. Long bodies refer to strong buying or selling pressure. If there is a candlestick in which the body close is above the open with a long body, this indicates that the buyers are stronger and they are taking control of the market during this period of time. Conversely, obviously, we have the opposite with a bearish. Now we also have short and small bodies which indicate little buying or selling pressure. So I'll actually go back to the previous slide to show you this. This candlestick right here, you can see the actual body close is really thin. Price did not do much in that whole 1 hour of being open. So other than the wicks, the body close actually really did nothing. So it's kind of indecision or unsurety as to where price is going. So the small bodies give you little buying or selling activity. It's just kind of ranging or doesn't really know what to do. Now carrying on from that, obviously we have the bodies and the wicks like I just told before. What do the candlestick wicks actually mean? What's the psychology behind them? So the upper and lower wicks give us important information about the trading session. Very important. You use these a lot, especially these candlesticks. So remember them. Upper wicks signify the session's high, while lower wicks signify the session's low. So remember the candlesticks are based on time frames, and wherever they close, the actual movement in that time period was the wicks, but the actual close price is based off the body. So candlesticks with long wicks reflect significant price movement between the opening and closing prices. However, the close price wasn't even near. So have a look at the psychology of this candlestick right here. So you can see it's got a long wick up the top and a little body down the bottom, and then just a little bit of a wick at the bottom. So what does this tell us? The buyers try to push the price up but failed. You often see these near resistance. So in this time period, let's just say it's an hour candle, you can see at one point the candlestick could have looked like this. Massive bullish candle. But by the actual close of that 1 hour, it's all the way down here. So what does that tell us? In this 1 hour, price tried to push up, but it got rejected and it left a wick up the top, leaving us with this body close down here. So remember, we had open price here at the top and then close. So price tried to go up but failed and closed down, leaving a big wick up the top. If that's what that does, it means that price didn't go up. What does it mean if there's a long wick down the bottom? Obviously, just the opposite. Price tried to push down, rejected, and actually closed up here. So the sellers try to push the price down but failed, and you often see this near support area, so an area of interest, resistance, support. So let's just recap candlesticks really quickly before we move on to candlestick patterns. So candlesticks represent the price move within a specific time period, showing the open, high, low, and closed prices. So they highlight key areas where price has rejected, indicating potential reversals, or where price has surged, signaling a strong move or momentum in one direction or the other. By analyzing candlestick patterns, traders can gauge market sentiment and make informed trading decisions. So now we'll move on to candlestick patterns, and they also have psychological meanings behind them, which you'll see now. So candlestick patterns are a great indicator. So they help you with your trading, but they're just used as one of the many confluences you'll need in your rules to trading. So they're not the holy grail. You can't just look at candlestick patterns and think, yes, because they've done this, price is going to do this. So candlestick patterns are the language of the market. If you know how to read candlestick patterns the right way, you'll be able to understand what these patterns are telling you about the market and what's happening behind the scenes. This skill will help you be better at entering and exiting the market at the right time. So a lot of these snippets are just from the Candlestick Trading Bible, but you see them playing over and over again in the actual live market. So remember what I said about the psychological meaning behind them. So I guess the first pattern we can look at is engulfing candles. So we have obviously bearish, meaning downwards movement, and then bullish for upwards movement. So first of all, bearish engulfing. Engulfing meaning bearish, so downwards. Downwards candle is fully engulfing the first candle. So the first body is smaller than the second one. In other words, the second body engulfs the previous one. So have a look. What does this mean? It shows us that the sellers are in control of the market, or they are pushing the price down. So when this pattern occurs at the end of an uptrend, this indicates that the sellers are taking control of the market. For example here, price came up, had a bit of an indecision candle up the top, and then big bearish engulfing, taking price movement downwards. Now we have bullish engulfing, which is pretty much the exact same but opposite. So bullish engulfing, big green candle engulfing a smaller red candle. So it's important to remember that the first candle is smaller than the second one, and the second one totally engulfs the first candlestick. So don't try to trade the market using this price action setup alone, because you'll need other factors of confluence to decide whether the pattern is worth trading or not. So obviously at areas of interest or on a higher time frame. So we'll get into this later as the course progresses. Next up, we have a pretty important candlestick. I really do like seeing these, and it's indecision, or some people call them doji candlesticks. Pretty much, I did kind of briefly touch on this earlier, but it's price opening and closing at pretty much the exact same price it did. However, in that time period, it moved up and down. So the buyers tried to take it up, didn't go anywhere. Sellers tried to take it down, didn't go anywhere. It actually closed pretty much where it started. So price is indecisive. It doesn't know where to go. As you can see, this pattern occurs at an uptrend or downtrend at areas of interest like support or resistance. So prices come up and then it's hit this point where it might have been resistance in the past. It's come up to this area and price is like, oh, I don't know, I don't really want to go up, or I don't really want to go down. And then the next candlestick that follows is a bearish engulfing, and then that takes price movement down. Now we have dragonfly doji candles. So it's just another name for them. You can just look at them and know what they mean. So as you can see, price is all the way up here, and it tried to wick down, but it didn't. So Dragonfly Doji is a bullish candlestick pattern which is formed when the open, high, and close at the same price. However, it tried to push down but didn't. And as you can see, we usually see these forming at previous support levels. And this candlestick shows a rejection of price falling more. It shows that there is higher buying pressure in that area. So if price has come down, it's hit a level of support, maybe in the past, and the sellers try to push it down, but it's like, nah, rejected, and it closed pretty much here. As you can see, over time, it did eventually come back up. And the gravestone doji next up is pretty much the exact same, but opposite again, so it's bearish. So you'll see this at the top of a trend, try to push price up, rejected, and it's come down. And this would be shown at resistance, and it's showing high selling pressure. Alright, this next candlestick is really important. I really do like this candlestick pattern. So it's the morning star, and it's a bullish reversal pattern. So it often occurs at the bottom of a downtrend, and it consists of 3 candlesticks, this one. So as you can see, price would have been coming down. It's had its last bearish candle. The middle one is tiny. It's still inside these candles pretty much. So it hasn't gone any further down since this one. And then the third candle is bullish, pushing it up. So it's kind of, the psychology behind it is it's pulled down, it's paused, indecision, and then it's pushed back up, meaning it could be a reversal happening right now. As you can see, so the doji candle indicated that the sellers are struggling to push the market lower. So that's the middle candle right here. So price has come down. It's had its last push down. Then it's had this indecision candle in the middle. So price is kind of paused, and then it's pushed back up, which could be the buyers taking control, which is now going to make price go up. And once again, we have now the evening star, which is pretty much the same but opposite. So price has come up, paused in the middle, and then pulled back down. So the buyers are taking price movement up, indecision, and back the other way. Last but not least, we have tweezers. So we have tweezer tops and tweezer bottoms. So pretty much what the psychology behind these are is that price previously, so remember the red candle would have been open price here, closed price here. For the bullish candle, we have open price here, closed price here. So price has pretty much closed at the exact same as it did on the previous candle. So it's kind of showing indecision, or it could be a reversal as well. So the sellers have run out of selling pressure at the bottom, so it could flip bullish. And then obviously we have just the opposite for a tweezer top. So that's the last one I'll be covering in this video. However, there are a few more, so if you really do want to see them, these are just the ones that I kind of look out for and are easy to remember. So if you do want to see some more, have a look at the Trading Candlestick Bible. It's a free book you can find online. It's like 80 pages. And it's probably good for beginners to read it because it goes through a few other things as well. So I'll leave a link in the description below. Just have a look at it. It's a free book. Why not? So as I keep saying, you got to keep in mind that the market will print candlestick patterns, but it doesn't particularly mean that price is going to do that, because it's not a video game and price movement is kind of random. But I've just taken a screenshot from a random chart, and I believe this is the daily chart. So just pause the video and see at these areas of interest some candlesticks forming, if you remember them from previously. So just pause the video and have a look. Alright, so this is what I saw. You might see some other ones, but this is what I've seen. So price is rallying up, and if you can see these 3 candles here, we have a push, then we also have a pause. You can see equal wicks, high and low, and then we have this pull. So that could be an evening star right there. So we had the push candle in the middle here. We had long wicks up the top and bottom. So it's like indecision. Price didn't know where to go at the top, which is coincidentally a level of resistance. And then we had a big pull. And as you can see, price did actually reverse from that candlestick pattern right here. Evening star. Next up at the bottom, we had a double bottom, which I'm actually showing later on in this video. So we came down, bounced off, came back up, down, came back down to this level of support, and as you can see, this candlestick right here looks like this. So what does that tell us? Like I said before, price tried to move down and it completely rejected it, and as you can see, it rejected it and then it went up. And obviously it happened at an area of interest, which was, in this case, the support. So this candlestick formed at support and this formed at resistance. Next up, you can see sort of another rejection up here at this resistance level, which is this grey box I've lined out. Price tried to move up and it rejected with a long wick up the top, and it actually did end up coming down after that. And then over here, this might have been a news event, but we have a massive bullish engulfing, and it broke structure. So it broke this resistance, break of structure, and it kept on going up after that. So that's just a few examples. If you just look, and you particularly look at higher time frames, these candlestick patterns forming will make more sense. If you look at an M5, you might see evening stars or rejections left, right, and center, and they mean fucking nothing because you're on a small time frame. Remember the psychology. So these are the three main patterns for reversals that I look at. So we have the doji candles, which could be indecision or rejection. Just draw them out. So we have price on this one, price trying to move down, but it rejected and closed back up. Indecision, so price try to go up, try to go down, and just kind of closed in the middle. And then we have price trying to push up, but it eventually closed down right here. So that's the doji. Next up we have the inside bar. So it's going to be a big candle with a little candle inside it. So we were having movement, but then it kind of didn't have movement. So if you see this in a lower time frame, on a higher time frame, it's probably going to look a bit like a doji. The third one, so push, pause, pull, this is the morning star and the evening star pattern. So we have a push, we have a pause, and then we have a pull. And then for the morning star, we have a pull, pause, push. It's an easy way to remember it. Push, pause, pull, push, pause, pull, pull, pause, push. 3 candlesticks, the morning star reversal pattern. So I'm just going to show this one more time to really drill it into you. So we have complete indecision right here with the long wicks up the top and the bottom. Price pretty much closing where it opened. Now we have the bearish, so price tried to push up, but it didn't, so it's got this long wick up the top. And then the bullish, so price tried to push down, but it rejected, and then it closed up the top. Here's that inside bar I was talking about before. So an inside bar pattern is made of 2 candlesticks. The first is the mother and the second is the baby. So the Japanese call this a haromi or something, and it's supposed to mean the pregnant woman. So here's the mum and here's the baby in her belly. All right, easy way to remember it. So the second candlestick fails to close higher or lower than the previous candle's range. This indicates that the buyers or sellers, none of them won, so it's indecision. And you see this near support or resistance. So it's much like the doji, and you might see this on a lower time frame, and on a higher time frame it looks like a doji. When it comes to reading candlesticks, you must wait for a candlestick closure. Candlestick closure will help you avoid getting in early and getting faked out. So I'll show you an example on the next slide, but basically if there's resistance and you've been bouncing around and market's opened and you get a candlestick that's showing nice bullish price action, it looks like this while it's open. You enter a long, expecting price to carry on. However, by the time that candle closes, it actually looks like this. It closes below that with a nice long wick up the top, and price just goes down and hits your stop loss. So it is important to wait for a candlestick closure so you avoid false signals. A candlestick closure will also give you an indication of who is in control of the markets during that time. So the buyers or the sellers. Right here you can see the sellers are in control at a candle close. While it was open, it looked like the buyers were in control, but they actually weren't. So the wicks of candles will definitely tell us something, but we need a body close to actually be an indication of a break of structure. So I'll cover this more in the next lesson. But as you can see, London Open was actually this candlestick here. This is on the DAX. So the London trading session opened on this candle here. Price didn't break above this previous level of resistance, and then it kind of came up and rejected with this wick. Price did eventually come down and have a candle body close below this line here. So this indicates that, yes, it's broken structure. So you have to wait for a candle close to actually form, because if you entered on this, you could have seen it come in above and you would be like, yes, I'll buy. However, it didn't close above that level. So you got to wait for a body close to break structure. And I do believe I cover this more in the next lesson of market structure, breaking structure and all that. So this is just briefly that you need a candlestick close as a confirmation. Just have a brief, quick look, recap at what we learned. So if you understand why a candlestick is formed, you'll understand what happened in the market, sort of behind the scenes, and it can help you predict where price is likely to go. Candlesticks show us a range of where price has moved over a time period. Candlesticks have a psychological aspect to them, and it can tell you sort of what's happening behind the scenes. Candlesticks form patterns which tell us what's happening. Candlesticks form at areas of interest. Very important, so support and resistance or on the moving average. The size of a candlestick shows how big of an order has entered the market as well. Later on, I do believe I talk about wide range bars, which what you would have maybe seen online, people referred to as, what do they even call it? It's that ICT fucking rubbish shit. What does he call them? Fair value gaps. So if you got a big candle, fucking fair value gaps. They're called wide range bars. So if you have a massive candle that opens, I don't know why the fuck I'm covering this. I'm covering it later, but pretty much, if you have a massive candlestick like this pushing upwards, it's a big bank order, so price is likely to come back and test that level. But I do cover that later, so that's just a brief explanation. So candlestick formations give us stronger indication on higher time frames. Remember that's important. The M5 will be spitting patterns everywhere. Whereas if you look in a higher time frame like the H1, H4 daily, they'll make more sense and they'll probably react more to what they're forming. Now let's have a look at bigger time frame candlestick patterns. So the previous ones I showed you were 1 candlestick, 2 candlestick, and 3 candlestick patterns. These bigger time frame candlestick patterns are pretty much market structure. So let's have a look right now. So there are many patterns out there, but I'll show you the ones that I like and I'll show you them in action. So trying to remember every single pattern can be tricky. These are the main patterns that I look for, and these patterns either happen at support or resistance, weekly or monthly levels. There's a psychology behind these patterns, much like with the candlesticks. So knowing the psychology behind candlesticks and patterns is important to becoming a profitable trader. So you don't actually really need to remember these stupid drawings, but if you remember the psychology behind them, they do make sense, and we'll get into them now. So first up, everyone knows this, we have the double top. So what is this telling us? Price is failing to make a higher high. So you can see price is coming up, it's having its legs, it hits a high. It has a big wick up the top, rejecting, bringing price down. Price comes almost back up, comes back down, comes back up literally to that exact box that I drew. So remember, it doesn't happen exact. This is why traders draw rectangles or sort of areas. They're areas of interest. They're not an exact line. If you drew an exact line, you're probably not going to get it half the time. But if you have an area with a box or a rectangle, an area of interest, that's the area of interest up here. So price came back up and it failed to go higher, so it's going to come back down. Patterns can be messy. Patterns can be messy and they don't always look like they do in the textbooks, but as long as you can understand why they're forming, you can use them to make money. So here's another example here. This isn't the prettiest of double tops, or really it's kind of like a triple top, depending on what time frame I'm looking at, I don't remember. But look at all the wicks at the top. Price does not want to go higher than there. It does not want to move any higher, and what do you know? Eventually price moves down. So next up we have head and shoulders, or the W pattern. I'm calling it the head and shoulders because it's easier to remember. So as you can see, we have a shoulder and a head, and then we have another shoulder. Easy. Head, shoulders. So what's the psychology behind this? So you can see price is coming up, doesn't want to go, comes a bit higher, doesn't actually want to go higher, comes back. Now this is the important part. It comes back, but it doesn't go higher. So it's kind of broken structure here already. Price come down, comes back up, tests this area, and it fails to go higher. So it eventually does come down. As you can see, it came back to this level here, pretty much exactly. So price bounced down, back up, retested this, which is called the neckline, which is like where the head and shoulders are. So we have the head, shoulders, and then the neckline will be over here. So that's the neckline here, and price typically retests that again and rejects. If it does, you got to look at the candles, so you can see a nice bearish engulfing right there. So you got to pair big high time frames with lower time frame candlesticks, and it can be confusing at the start, but the more and more you look at it, the more it'll start to make. This is another example. What can you see at the top? So obviously price has failed to come above that level. It's come back, failed to come above, come back, almost gone above but failed, and now it's come down. So what can you see at the top? Just look at all the wicks. So this is pairing the higher time frame actual analysis of price not going higher, and it's pairing it with the actual candlesticks we followed before. So look at all the wicks. Price does not want to go higher. It's rejecting it hard. It does not want to go higher, and it's just played out pretty much textbook, this one. So note this was at a monthly high, and the RSI was extended on the daily chart as well. So here's the key points to remember. You have to remember this. Candlesticks forming and candlestick patterns, even on higher time frames, they need to happen at a level of interest. If you're trading candlesticks in the middle of a fucking range, like right here, in the middle of a nice strong resistance and a nice strong support, what do they even mean? Price is going to go touch these levels. It's either going to reject or it's going to break above, retest, and carry on. So if you're trading in the middle of a range, especially looking at candlestick formations in the middle of the range, they're not going to mean anything. So you have to look at a level or an area of interest. So also remember that candlesticks are showing us psychology of what's happening, so it can show us where price is rejecting or gaining momentum for a strong move in one direction. Candlestick patterns are made of many candles. Candlestick patterns can be used as a confluence or an indicator to enter a trade. So it's not the only confluence you need to enter a trade, but it can be used as one of the confluences for your trading plan.